You know that feeling? It's a very specific sinking feeling that just hits you right in the chest.
Oh, I know it well.
It's Sunday night. The clock is ticked past 9 by 00 p.m., and the weekend is, for all intents and purposes, officially dead. You've got a cup of coffee on the desk that probably went cold about 2 hours ago,
Yeah, at least 2 hours ago.
and you are staring at a computer screen that feels like it's practically mocking you. You're looking at a Windows folder structure with, I don't know, 400 disorganized PDFs.
It's the absolute worst. It is the modern corporate nightmare right there.
Right. It is just this wall of files with names like Q3 Final 2 EDI Real.pdf. And sitting right next to that folder, you've got a capitalization table open in Excel that looks like it was built by a madman.
Oh, the cap table.
You know, the type circular references, hard-coded numbers that are hidden in white font so you can't even see them, tabs that don't link correctly. You are just dreading the week ahead. We call it the Sunday Scaries, but for an M&A professional, this has a specific name. It's Excel hell.
It is such a visceral reality for so many people in this industry. It's that exact moment where you realize that despite all the money involved in mergers and acquisitions, and I mean, we are talking about trillions of dollars moving around the globe annually.
Trillions. It's staggering.
It is. But despite the high stakes, the pinstripe suits, and the, glamorous reputation of deal making, the actual day-to-day work is incredibly manual. It's fragmented. It's so tedious. And frankly, it is wildly inefficient.
You find yourself fighting the documents instead of actually analyzing the deal.
That's it exactly. You're wrestling with the tools, not the thesis.
And that is precisely what we are unpacking today. We are going to do a deep dive into why the traditional M&A toolchain, that stack of software that almost everyone in the industry uses, is fundamentally broken. And then we're going to look at a fascinating case study of how things are shifting, specifically focusing on a platform called Synergy AI.
But this isn't just about software features. I think that's a really important point to make up front.
No, not at all.
We are talking about a fundamental shift in how capital actually moves, how deals get done from start to finish.
Right. Because the context here is absolutely vital. Before we can even get to the solution, we have to understand the paradox of the current market. Because if you just look at the headlines, you'd think everything is fine.
You'd think it's business as usual.
It's really surprised me in the research notes for this. There is no shortage of money out there, is there?
Not at all. That's what we call the synergy gap, or the great paradox of the 2020s. We have record levels of what the industry calls dry powder.
Which is just cash waiting to be invested.
Exactly. It's capital sitting in private equity funds, in family offices, on corporate balance sheets, just waiting to be deployed. The money is there. It is literally sitting in the bank. The problem isn't a lack of capital, it's a lack of information liquidity.
Information liquidity. Okay, that's a really interesting phrase. Let's double click on that. What does that mean in plain English for someone who isn't, a macroeconomist?
Well, think of it this way. Liquidity usually refers to cash. How easily can you turn an asset into cash to spend it?
Right.
But information liquidity refers to how easily you can access the truth about a business. Right now, you have the cash to buy a company, but finding the right company, verifying that it's actually a solid business, and then closing the deal is incredibly difficult because the data is stuck.
It's frozen.
It's frozen. It's stuck in those 400 disorganized PDFs you mentioned. It's stuck in siloed databases that don't talk to each other. And very often, it's stuck in people's heads.
Yeah.
The friction costs of moving information from I want to buy a company to I have bought a company are they're astronomical.
So you have liquid capital, but illiquid information. The money can flow, but the knowledge can't.
That's the perfect way to put it. The pipes are clogged.
And the tools we're currently using, I assume they are supposed to be the plumbers here, but based on what we're reading, they're not really helping.
They're point solutions. That's the problem. They solve one tiny slice of the problem, but in doing so, they create friction somewhere else down the line.
Okay, so let's talk about that. The old stack, as the notes call it. What are we talking about here?
Well, you've got your legacy aggregators. Think PitchBook, CapIQ, Orbis. These are the giants in the space. And they are fantastic for historical data.
Sure.
If you want to know what a company's revenue was back in 2022, they are great. But are they good for real-time signals for what's happening right now? Not really.
Right, they're like reading yesterday's newspaper. By the time the data is cleaned up, verified, and entered into PitchBook, everyone in the world knows about it.
Exactly. It's a lagging indicator, not a leading one.
Yeah.
So then you move down the stack to the storage layer, data site, intralinks. These are basically secure vaults.
Virtual data rooms.
Precisely. And they're essential for security, absolutely. You need a safe place to put the tax returns where hackers can't get to them. But they are passive. They're just digital buckets. They don't read the files inside them. They don't analyze them. They don't tell you, hey, there's a huge risk in this legal clause on page 87.
They just hold the file and send you a bill for storage.
That's the business model. And then at the end of the line, you have the bulletin boards, places like Deal Suite. These are supposed to be where buyers meet sellers, right?
Theoretically, yes. That's the pitch.
But in reality, we often describe these as walled gardens. You only see what someone else wants to show you. It's a totally passive marketplace. If you are seeing a deal on a bulletin board, it's because a broker put it there for a reason.
Which brings us to a crucial point about competition. If a deal is on a bulletin board, it's, by definition, on market.
Precisely. If it's on market, it means you and 50 other private equity firms are looking at the exact same PDF teaser at the exact same time.
Which means the price immediately goes up.
And your chances of winning go way down. It becomes a bidding war, an auction.
So the whole mission of this deep dive, then, is to explore how the industry is trying to escape this trap. We're exploring the shift from the information age, where we just, hoard data in these databases and hope to find a pattern, to what our sources are calling the agentic age.
The agentic age. I really like that term. It sounds a bit sci-fi, but I think it's very practical.
It is, isn't it? But what does it mean?
It's closer than you think. It's the shift to using AI that doesn't just store information or, summarize a block of text. It's AI that actually reasons, plans, acts, and executes workflows on your behalf.
And Synergy AI is the lens through which we're going to look at this, because they're making a pretty bold claim. They claim to be building an operating system for capital.
Which is a huge claim. An operating system implies it runs everything, end to end.
It does. So let's test that claim. Let's walk through the actual life of a deal, starting right at the very beginning, sourcing. Or as I like to call it, the needle in the haystack problem. The sources describe a sourcing crisis. Why can't we find good companies anymore? The internet is right there. We have Google.
The internet is there, but the map we're using to navigate it is hopelessly outdated. The traditional method, as we touched on, relies so heavily on codes, specifically SIC Standard Industrial Classification, or NAICS codes.
Right.
These were invented decades ago. Their purpose was to categorize the economy for government statistics. They were never designed for deal sourcing.
Right, I've seen these. It's stuff like manufacturer of rubber hoses or wholesale grain distributor. It feels very industrial revolution.
Exactly. But modern businesses are hybrids. They are messy. They don't fit in neat little boxes anymore. Let's take an example. Imagine a company, let's call them Hose Tech. They manufacture rubber hoses, yes.
Yeah.
That's their legacy business.
So their SIC code is rubber hose manufacturer.
That's what it says on the tin. But their real value, the reason a private equity firm would want to buy them, is that they now sell a subscription SaaS platform that uses IoT sensors to predict when those hoses will burst in a factory. And on top of that, they have a consulting arm that trains mechanics on this new system.
Okay, so what code is that?
Exactly. What code is it? It's manufacturing, it's software, it's IoT, it's professional services.
If I'm the founder filling out the incorporation forms, I probably just check the box for rubber hose manufacturer, because it's the easiest thing to do.
Right.
Yeah.
Because that's what's on their old tax documents. That's what their dad did. So if you are a private equity firm with a brilliant investment thesis on industrial IoT or SaaS-enabled manufacturing, and you go into PitchBook and search for those high-tech codes.
You miss them. You miss Hostech completely.
They're invisible. They're hidden under the boring legacy code. Or you get the reverse problem. You search for software and you get a list of 5,000 companies, and 4,900 of them are totally irrelevant. Mobile games or, crypto startups. The signal-to-noise ratio is just terrible.
So the codes act as blinders. You're either seeing nothing relevant or you're seeing way too much of the wrong thing.
Completely. And here is the real kicker. Because every single firm uses the same codes and the same databases, everyone sees the same lists. This leads to what we call the reactive trap. You just sit back, you wait for a broker to send you a teaser, a simplified pitch document, and you react to it.
But if a broker sends me a teaser...
They sent it to 300 other people.
So I feel special receiving it, but I'm really just number 205 on the mailing list.
You are definitely not special in that scenario. So now you are in an auction process. And when you are in an auction, you are paying top dollar. You're paying 10x EBITDA, 12x EBITDA or more because you have to bid against the entire market.
There is no alpha, no excess return in an auction process because the price is just driven up by all that competition.
None. You might win the deal, but you've almost certainly overpaid for it.
So how does Synergy AI, or this agentic approach we're talking about, how does it change that? Because the briefing mentioned something called Mandate Alpha. It sounds like a spy movie title.
It does, doesn't it? But it's actually quite logical when you break it down. This is where it gets really fascinating. They move away from keywords and codes entirely. They use what's called semantic inference.
Okay, semantic inference, that sounds like a buzzword. Break that down for us. How is that different from just typing something into Google?
It's the difference between searching for a word and searching for a meaning. Instead of typing SIC code 3041, you type in your actual investment thesis, your mandate. You use natural language.
So you just write a sentence.
You write a full thesis. You can say, find me Belgian B2B SaaS companies in the HR space with under 5 million euros in EBITDA that are showing signs of founder fatigue.
Whoa, hold on. Founder fatigue, you can search for that. That's a psychological state. There's not a business metric you find on a balance sheet.
And that is the agentic difference. The AI isn't looking for the literal text founder fatigue on a company's website. No CEO is going to write, I am tired and want to sell on their homepage.
Right?
It's looking for signals. It's inferring the condition from a constellation of data points.
What kind of signals? I'm fascinated by this. How can a computer possibly know that a founder is tired?
Well, it looks for breaks in patterns. For example, maybe the founder hasn't posted on LinkedIn in 6 months, whereas for the past 5 years they posted weekly. That's a signal.
Interesting.
Maybe the company hasn't released a major product update in over a year. Maybe they just settled a messy lawsuit that was a huge distraction. Or maybe there's been a noticeable drop-off in employee headcount growth. Or Glassdoor reviews are suddenly mentioning a lack of direction.
These are all things that are publicly available, but no single human could ever track all of them across thousands of companies.
Exactly. These are meaningful patterns that suggest a company might be stagnant or the owner might be looking for an exit, even if they haven't told anyone yet, even if they haven't hired a broker.
So it's not just understanding the words in my search. It understands the intent of my search.
Yeah.
It creates a profile of what I'm actually looking for.
Yes. It creates what they call a user context vector. It understands who you are, your firm's history, your past deals, your stated preferences, and combines that with what you're looking for right now. And crucially, it doesn't just query a static database of old tax returns. It scans the live web.
What does that mean? Scans?
It means it's actively looking at news articles, press releases, job boards, changes to corporate registries. It's an active real-time process, not a passive query of old data.
There was one feature in the notes regarding sourcing that really caught my eye, the lookalike strategy. It seemed almost too easy. You can just dump a URL in.
This is a favorite for firms that are trying to execute a buy and build strategy. Let's say you love a specific company, Company A. They are perfect. They are the ideal target for your platform, but Company A is too expensive or they simply don't want to sell.
Well, they just got bought by your biggest competitor.
Exactly, so you're stuck.
In the old world, yes. You'd go back to the drawing board.
In the new world, you take Company A's URL and you paste it into the Synergy AI M&A Finder. The system then analyzes everything about Company A, its business model, its customer base, its pricing page, the technology stack it uses. It creates a sort of digital fingerprint of that business.
Okay.
And then it goes out and scans the entire web to find every other company in Europe or the US or wherever that looks like that structurally.
Even if they describe themselves differently, like if Company A calls itself fintech, and Company B, which is basically the same, calls itself payment processing infrastructure.
Exactly. Even if they don't use the same keywords at all. The AI finds the business model match, not the keyword match. And these are the hidden gems. These are your off-market targets.
Companies that haven't hired an advisor.
So when you call them, you are likely the only one calling. That is where you find true proprietary deal flow. That is mandate alpha.
So instead of fighting 300 other bidders in a formal process, you're having a quiet coffee with a founder who didn't even know they wanted to sell yet until you called and explained the opportunity.
Precisely. You are shifting from being a fisherman waiting for a fish to swim by to being a hunter actively using radar to find your target.
I love that analogy. Okay, so let's say the radar worked. We found the company, We source the deal, we have the teaser, or maybe just some raw data we've pulled. Now we enter the next circle of hell.
The diligence bottleneck. This is where deals go to die a slow death.
The notes mention the intelligence gap here, and this stat just blew my mind. Senior partners and associates waste 35% of their capacity on low-value sourcing and administrative tasks. 35%, that's more than a third of their professional life.
It's huge. It's an incredible waste of very expensive, very smart people's time, and it leads to a very real phenomenon that our sources call the Monday morning problem.
What is the Monday morning problem?
Okay, imagine a junior analyst. It's 4:30 p.m. on a Friday. They've reviewed 50 pitch decks this week. They are tired. They are completely burnt out. They are thinking about the weekend.
I've been that analyst.
We all have. They open the 51st deck. It's a bit complex. The business model isn't immediately obvious. It requires some real digging to understand the value proposition. What do?
They pass. They reject it. Not a fit.
Exactly. Too risky, not a core fit. Pass. They just want to clear their inbox and go home because they just don't have the mental energy left to properly process it.
But if they had seen that same deal at 9 a.m. on Monday morning, fresh after a coffee,
They might have seen the nuance. They might have seen the hidden potential. They might have said yes. Human fatigue and cognitive load introduce massive variance and randomness into the decision-making process.
that's terrifying if you're the founder of that company trying to raise money.
Mhm.
Your entire company's fate could depend on whether the analyst had a good weekend or how much sleep they got the night before.
It really does. And this is where the AI deal qualifier comes in. This is a core part of the Synergy ecosystem. You take that pitch deck, that PDF, or in many cases, even just the company URL, and you upload it.
And what happens? Does it just summarize it for you? Because I can get a summary anywhere these days.
It goes way beyond a simple summary. It performs instant triage. The AI acts as that first-line defense analyst, but it never gets tired. It reads the document instantly. It cross-references the claims in the deck against the live web.
So if the deck says, we are the market leader.
The AI immediately checks that. It looks at web traffic, app store rankings, customer reviews, and says, actually, you're number 4 in the market, and your market share has been declining for 3 quarters.
Wow.
And then it outputs what it calls an executive verdict.
An executive verdict, like thumbs up or thumbs down, buy or pass.
More nuanced than that. It might be strong fit, go with caution, or reject. It gives you a synergy score based on your firm's specific mandate. It identifies the 5 to 10 key risks immediately, and this is incredibly helpful for the junior staff. It generates a list of questions for management.
Oh, that's brilliant.
So when you do get on that first call with the founder, you aren't asking generic time-wasting questions like, so tell us about your team.
No, you're asking, hey, your pitch deck says revenue grew 20% year over year, but our analysis of web traffic and public data suggests user growth is flat. Can you help us understand that divergence?
You are starting the conversation at level 10 instead of level 1. It completely changes the power dynamic.
The stat from the go-to-market strategy document says M&A due diligence hours can be reduced by 75%, from 40 hours of just preliminary reading, cross-referencing, and Googling.
Down to just 10 hours of high-level strategic validation.
That is massive. That's not just saving time, that's saving your weekend. That could fundamentally change the lifestyle of the industry, which is notoriously burnout heavy.
It is. But there's a secondary benefit to this AI triage that is often overlooked, but I think strategically is even more important in the long run. It's the triage log.
What's that?
Well, think about the manual world. If an analyst passes on a deal today, what happens to that information?
They delete the email or archive it? It's gone.
It's gone. 2 years later, a senior partner is at a conference and asks, hey, did we ever look at company X? They just raised a huge round at a massive valuation, and no one in the firm remembers. Or if they do, they don't remember why they passed. Was it the price, the team, the market conditions at the time, the data, the institutional knowledge is lost forever.
Right, it's lost in the email ether.
Synergy AI records the reasoning for every single decision. It builds a permanent institutional memory. Every time you pass on a deal, the system logs why. It logs the risks that were identified, the score it was given.
So you can go back and see, oh, we passed on them in 2024 because their customer churn was 25%.
Exactly. And maybe now, in 2026, you can see from new data that they've fixed that problem and their churn is down to 5%. So you can re-engage immediately with full context. You aren't starting from scratch. You are building a knowledge base that compounds over time.
It turns the firm from a simple transaction machine into a learning organism.
That's a great way to describe it. It's the difference between a firm that just processes deals and a firm that learns from the market in real time.
Okay, so we've sourced the deal, we've qualified it, we've triaged it, we like it. Now we have to execute. And we are right back to my Sunday night nightmare, Excel, the financial modeling phase.
The modeling nightmare. This is where the rubber really meets the road in any deal.
And it's where the dreaded fat finger error lives. I think everyone who has worked in finance has a war story about a fat finger error.
Oh, absolutely. I've seen it happen on live deals. A decimal point in the wrong place, a plus sign instead of a minus sign, a broken link between the cash flow statement and the balance sheet.
You change one assumption about the cost of capital in one cell, and suddenly the entire model just breaks. You get #REF errors everywhere. Or, even worse, it doesn't break.
That's the real fear, isn't it? When it doesn't give you an error, it just gives you the wrong answer.
Exactly. It silently gives you the wrong answer. It says the company's worth $50 million when it's really worth $30 million, and you go and base a binding legal offer on that number because you didn't check the formula in cell G45.
Chills. I literally have chills thinking about that. It's every junior person's worst nightmare and every senior person's biggest risk.
So how does Synergy Quant fix this? Is it just a better calculator? A fancier spreadsheet?
It's a fundamentally different approach. They call it an AI sandbox. It doesn't just spread numbers that you type in. It builds the model logic from the ground up. You feed it the raw financial data, and this can be messy data, like scanned audits, ugly CSV exports from an accounting system, and it reconstructs the P&L, the cash flow, and the cap table. It understands the accounting relationships between them.
But M&A isn't just about historical data. It's all about the future. What if I want to play with the assumptions?
That's the magic. It's fully dynamic. If you change the churn rate assumption from 5% to 7%, that change ripples through the entire model instantly and accurately. It performs sensitivity analysis automatically. It can tell you, okay, if churn goes up by 1%, your IRR, internal rate of return, drops by 2.5%.
So it allows you to play what-if scenarios without the constant fear of breaking the spreadsheet structure.
Exactly. It completely shifts the analyst's job. Their job is no longer building the spreadsheet, which is low value and extremely high risk. Their job becomes stress testing the business, which is the highest value activity they can perform. You spend your time thinking about the actual business risks, not checking your formulas for broken links.
And then, once you've done the math, you have to present it. The dreaded investment committee deck. The CIM, the Confidential Information Memorandum.
The bane of every analyst's existence. Formatting PowerPoint slides at 2:00 a.m., aligning logos, making absolutely sure the chart on slide 4 matches the number on slide 40.
I've been there. The late-night emails with the subject line, PL's fix.
It's a rite of passage. And this is where the boardroom generator comes in. The name sounds powerful, and from what we've read, it is. The claim is that it can generate a 100-plus slide CIM in a matter of hours.
But the key isn't just the speed, right? It's the accuracy.
It's the data integrity that's the critical part. It auto-populates all the charts and tables directly from the Synergy Quant financial model we just talked about, so there is no version mismatch.
You don't have that classic situation where the slide deck says revenue is 10 million and the Excel model says it's 11 million because someone forgot to copy-paste the update after the last meeting.
That entire category of error is eliminated. It solves so many arguments in the boardroom before they even happen. And it goes further, it actually writes the narrative.
What do you mean it writes it?
It drafts the vision and discipline section, the traction section, the economics slides. It takes all the insights that were found during the diligence phase, those signals about founder fatigue or market positioning, and it weaves them into prose.
So it's writing the story of the deal, which is then backed up slide by slide by the verified data of the deal.
Correct. It allows the deal team to focus on the strategy of the negotiation. How do we position this deal to win, rather than the formatting of the document?
Okay, I have to play devil's advocate here. I have to. We are talking about AI writing legal documents, AI building complex financial models, AI making judgments about whether a company is good or bad. Everyone, and I mean absolutely everyone, is worried about hallucinations.
It is the elephant in the room. You can't have a conversation about AI in a high-stakes environment without addressing it.
Right. If I'm a senior partner and I'm about to sign a check for 50 million euros, How on earth do I trust that the AI didn't just make up a revenue number because it sounded plausible?
And you are absolutely right to ask that. You cannot trust a standard generative AI like, say, ChatGPT or a generic large language model with that specific task. They're designed to be creative, to be probabilistic. They are not designed to be factually infallible. This is why the entire Synergy AI platform is built on what they call grounding technology.
Grounding. Okay, how does that work technically? What does it mean?
They use Google's latest model, Gemini 2.5, which has a specific feature called grounding with Google Search. In simple terms, the AI is not allowed to just guess or autocomplete a fact. It has to cite its sources.
Like a bibliography in a university term paper.
Exactly like that. Every single quantitative claim it makes, revenue is growing 20% year over year, is anchored to a verifiable source. A URL to a press release, a specific page number in an uploaded PDF, a public filing. It provides total auditability.
So I could literally click a link next to the number and see the original document where it got that information.
Yes. The sales playbook for Synergy calls this a killer feature for due diligence. Their line is, our AI doesn't guess, it cites. That is the bridge to building trust with senior decision makers. It's not a black box, it's a glass box. You can see how it works.
That makes a lot of sense. So trust is good, but safety is even better. The outline also mentions a fraud sentinel. That sounds like a superhero from a comic book.
In the world of cross-border M&A, it kind of is. When you are buying a company in another country, let's say a Dutch firm is trying to buy a supplier in Vietnam, it is incredibly hard to verify everything manually. Is the person who's signing the deal actually the legal owner? Is the company even real, or is it a shell corporation?
Right. Does the factory they showed you on the tour actually belong to them, or is it just a P.O. box with a nice website?
Fraud Sentinel is designed to look for those shell patterns. It checks for registry mismatches across jurisdictions. It scans global watch lists and sanctions lists in real time. It performs deep executive identity checks.
So it's not just checking the company, it's checking if the CEO is who they say they are.
And if the corporate structure makes logical sense, manual checks often miss these things because they are so tedious. A human analyst might check the top layer of ownership. The AI can scan thousands of registry documents across dozens of different jurisdictions in seconds to flag anomalies. It can come back and say, hey, this holding company is registered to a residential address that also appears in the Panama Papers database.
That prevents you from buying a lemon. Or worse, accidentally getting involved in a major money laundering scheme.
It's advanced risk mitigation at a scale that humans just can't match.
Okay, so we have sourcing, diligence, execution, and safety. It's a good point to zoom out a bit. We started this whole conversation by talking about the agentic age.
Yes.
What does that shift really mean for the people who do these jobs? Are we just replacing junior analysts with robots? Is the future of M&A just servers talking to other servers?
It's not about replacement. It's about evolution. And it's an important distinction. We are moving from generative AI, which is what most people are familiar with now, using it to write emails or summarize text, to agentic AI. An agent doesn't just respond to a prompt. An agent plans. It executes multi-step workflows.
Give me a concrete example of an agent in action here. How does it feel different to use?
Okay, let's go back to the sourcing example. In the generative world, you go to a chatbot and you ask, give me a list of HR tech companies in Belgium. It gives you a static list, the task is done. In the agentic world, you give an agent a mission. You say, act as my virtual scout. Your goal is to find 3 proprietary acquisition targets in the HR tech space that fit our mandate. The agent then goes out, it scans the web, it finds 100 potential companies, it filters those results based on your criteria, it reads their websites and available pitch decks, it checks for risks, it discards the bad ones, and it comes back to you with a short list of 3 companies and a detailed rationale for each.
So it performed an entire process, not just a single task.
That's the difference. It's like sending a junior associate to do research, but they come back in 5 minutes instead of 5 days, and they've done better work.
And this leads to what the notes call the biggest strategic advantage of all. We talked about mandate alpha in sourcing, but there's also the data moat.
The data moat, this is something Warren Buffett would absolutely love.
He would.
Yeah.
So in the old world, the competitive advantage was relationships, right? I know the right guy, or I went to school with the broker.
It was all about the Rolodex.
In the new world, the advantage is the proprietary data moat. How do you build that? If every firm uses Synergy AI, doesn't everyone have the same advantage? Doesn't it just level the playing field?
That's the clever part of the strategy. Every single time your firm uses the Synergy AI platform, every time you accept a deal, reject a deal, change a financial model, edit a presentation slide, you are creating what they call digital exhaust.
Digital exhaust. I like that image. It's the data trail you leave behind.
It's a trail of your decisions, it's feedback loops. The system learns. But it doesn't just learn in general, it learns you. It learns your firm's specific preferences. Oh, this firm hates companies with high customer concentration. This firm loves companies with recurring revenue in the Benelux region, but only if they have a CTO on the founding team.
So the tool actually gets smarter and more personalized to me and my firm over time.
Yes, it retrains your proprietary models based on your firm's specific behavior. Over time, the system becomes perfectly attuned to your specific investment thesis. It starts to see the alpha, the opportunity, where other firms just see noise because it knows what you value.
So if two different private equity firms use Synergy AI for a year, eventually they will get very different recommendations because the AI has learned that they want very different things.
Exactly. And that is the strategic lock-in. That is the moat. Your version of the tool becomes a unique proprietary asset that no one else has. The winner in 2026 isn't the firm with the most data. Everyone is drowning in data. The winner is the firm that can synthesize truth from noise the fastest. That's the entire vision.
That is a powerful vision. It's not just about doing things faster. It's about doing them with more clarity.
It's about conviction, speed to conviction. If you can get to a confident yes or a confident no on a deal in 2 days while your competitor is still taking 2 weeks to read the documents, you win. Every single time.
So let's bring this all home. We've gone from the Sunday scaries to the agentic future. If I'm a leader listening to this, a partner at a PE firm, a head of corporate development at a large company, what is the single biggest takeaway?
The takeaway is that the friction in M&A, the long hours, the missed data points, the Excel hell, is no longer a necessary evil. It is a choice. The tools now exist to fix it. We are moving from an era of point solutions, a disconnected mess of tools that don't talk to each other, to a unified OS.
The operating system for capital.
Yes, and the financial impact of that shift is very real. We are not just talking about saving a few junior analyst hours. We are talking about fundamentally shifting your most expensive resources' time from low-value administrative grunt work formatting slides, typing numbers into cells, to high-value strategic negotiation. That is where the money is made.
So the real question for leaders isn't, should I use AI?
No, that question is already answered. The question is this. In a world where deal saturation is the norm, where everyone is fighting for the same small pool of good companies, are you still relying on the same on-market lists as all of your competitors? Because if you are losing. You are paying retail price in a wholesale world.
You're fishing in the same small, crowded pond as everyone else, while the agentic firms are out there scanning the entire ocean.
Precisely.
That is a fantastic and provocative place to leave it. The choice is yours. Stick with the folder of disorganized PDFs or upgrade the operating system.
I know which one I would choose.
Me too. Sunday nights are for relaxing, not for rebuilding capitalization tables.
Amen to that.
Thanks for listening to this deep dive. We'll catch you on the next one.